1 minute ago, literally as we're talking, silver just posted one of the wildest rebounds we've seen in years. I'm talking about an 8.6% jump in a single day, ripping back toward $86 after collapsing 41% in barely a week. That's not a typo. 41% gone, then almost 9% back, like a rubber band snapping. You can almost hear traders' heart rates sinking to the charts. Most people see that and think stabilization, but stay with me, because that's not what this usually means. This is a market gasping after a sprint, not one catching its breath for a marathon. I'm going to show you why this specific reversal matters right now, and how to recognize these setups before everyone else starts shouting about them 2 days late. If you're watching this right now, you're ahead of the curve. Your job is to understand the mechanics before they become obvious to everyone else. Before I explain what actually caused this, let me teach you a quick rule of thumb about parabolic markets. Every asset, doesn't matter if it's silver, tech stocks, or tulip bulbs, moves like a spring. The more violently it stretches upward, the more force snaps it back when the tension breaks. Most people picture markets as calm seas, but they're more like pressure systems. As long as momentum buys keep feeding in, you get lift. The second that flow stops, air pockets form. That's when gravity reclaims what euphoria borrowed. Think of it like pulling a slingshot back. The farther you pull, the faster the snapback. No conspiracy necessary, just physics dressed in price data. When you see something rocket from $32 to $122 in 3 months, you're not watching sustainable demand. You're watching a spring getting stretched to its breaking point. And here's what almost nobody tells you. The snapback is always faster than the buildup. Always. The rally took months. The crash took days. The rebound? Hours. That asymmetry isn't random. It's how markets work when emotion overwhelms fundamentals. So what does that tell us? It tells us that what we're seeing right now isn't necessarily recovery, it's release. If this framework is making sense, drop a comment below because I want to know if you've seen this pattern play out in other markets you follow. Now here's what's actually happening in silver. The January rally to $122 sucked in late buyers who thought, this time it's different. That's always the most expensive sentence in the market. Every cycle, without fail, you hear it. And every cycle, it costs people fortunes. Then liquidation hit. Funds dumped positions. Margins tightened across the board. Prices plunged to $71 overnight on February 2nd. Shockwaves everywhere. Accounts blown. Stops triggered in cascades. But here's the thing. Markets don't fall straight forever. When everyone sells at once, someone's forced to buy just to close shorts or cover risk. You've got hedge funds unwinding positions. You've got algorithms hitting preset buy levels. Add dip buyers with cash and conviction, and you get a face-ripping bounce. That's what Tuesday was. A reflex move fueled by exhaustion, not a shift in fundamentals. Let me break down the sequence, because this matters. First, you had the initial collapse from $122 down to around $71. That's your primary liquidation event. Forced selling, margin calls, pure panic. Second, you had short covering. See, when silver dropped that fast, every short position suddenly became massively profitable. But profits don't count until you close the trade. Closing a short means buying. So you've got this wave of buy orders hitting the market from people who were betting against silver, now taking profits. Third, you had opportunistic buyers who'd been waiting on the sidelines. They see silver under $75 and think, value. They step in. All 3 of these flows converge on Tuesday. And what happens? An 8.6% surge in a single session. Silver rips from the low 70s back toward $86. Looks dramatic on a chart. Feels like redemption if you're holding bags from $110. But here's the part that should make you nervous. Stabilization requires new money, not recycled margin calls. Until you see consistent closes above resistance, call it $88 to $90. The odds still favor chop, not clarity. What we're watching is a tug-of-war between trapped longs praying for break-even and opportunistic bulls who see value under $80. This balance creates wide ranges. 5, 6, even $10 swings day to day. Volatility doesn't die quietly. It goes out kicking. The rebound looks impressive because it always does after forced selling. But don't confuse motion for progress. Both bar chart and institutional desk data confirm that positioning, not new demand, drove this rebound. You're not seeing fresh capital flooding into silver futures. You're seeing mechanical buy-side pressure from shorts covering and algorithms firing. There's a massive difference. One suggests a new trend. The other suggests a temporary squeeze before the next leg plays out. Wednesday's session will basically decide whether Tuesday's surge is a floor or just a trampoline before another drop. Watch the open. Watch the first hour. If silver can hold gains and build on them with volume, maybe we're seeing something real. If it fades by midday, you're watching the reflex bounce complete itself. If this feels familiar, it's because we've seen this movie before. Back in 2011, silver went from $49 to $32 almost overnight. Brutal. Then it exploded 15% higher in a single session. Everyone screamed, "Come back." It wasn't. Within 2 weeks, it retested those lows and then spent months grinding sideways. Go further back to 1980. Same structure. Vertical mania as silver hit $50. Brutal breakdown to the mid-30s. Then a heroic but doomed rally that sketched the top half of an M-shaped peak. That rally convinced people the worst was over. It wasn't. Silver eventually settled into the single digits for years. Even in the pandemic-run years, each blow-off top had the same reflex bounce before settling into months of sideways digestion. March 2020, silver crashed with everything else. Then it bounced hard. Everyone thought the bottom was in, but it chopped for weeks before actually establishing a sustainable uptrend. When you zoom out, you see this isn't chaos, it's choreography. Markets dance to positioning, not passion. The steps change slightly, but the rhythm stays the same. Every parabolic move ends with liquidation. Every liquidation gets a reflex bounce. Every reflex bounce convinces some percentage of traders that the danger's over. And every time the market decides whether that bounce was a gift to exit or an actual reversal. Right now, we're in that decision window. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this rebound actually mark a genuine shift? Maybe. Central bank buying in certain quarters has stayed solid. Some inflation prints are sticky. Industrial demand for silver in solar and tech hasn't vanished. The fundamental story people were telling at $120 didn't become false at $71. But here's the thing. It doesn't actually matter whether the long-term bull case is valid if the short-term price behavior is mechanical. Credible analysts will tell you this. Narrative strength doesn't always equal price strength right now. Silver's industrial story, its safe haven story, they're both intact. But price behavior is mechanical short-term. Don't fall for the social feed hysteria blaming manipulation every time volatility bites. Could there be large players influencing moves? Sure. Does that change what you should focus on? No. Focus on what you can control. Your sizing, your stops, and especially your emotions. The market doesn't care about your thesis if your risk management can't survive the volatility. There are probably 3 kinds of people watching this right now. The first group are the adrenaline traders. You live for these swings. You're watching 1-minute charts with your heart in your throat. You saw Tuesday's bounce and you jumped in looking for a scalp or a swing. That's fine. Totally valid approach. Just respect your risk. Volatility loves to humble overconfidence. If you're going to trade this chop, keep your position size tight and your stops even tighter. Because these rebounds can reverse in minutes. You know that. You've probably experienced it. Don't let a winner turn into a disaster because you got greedy on the back half. The second group are long-term stackers holding physical silver. You barely look at charts. You care about ounces, not ticks. You bought at $22, maybe $28, and you're holding for years. For you, this noise is just noise. But it's also opportunity if you've done your homework. If you believe in the long-term case and you've got dry powder, Pullbacks like this are gifts. Just don't fool yourself into thinking you can time the exact bottom. You can't. Nobody can. Dollar cost average if that's your strategy. Stack consistently. Ignore the day-to-day drama. Your time frame insulates you from this volatility, but only if you actually stick to your time frame. The third group is the learners, the ones trying to decode why something moves before deciding whether to act. You're my kind of viewer. You're here because you want to understand the mechanism. You're not looking for hot tips. You're looking for patterns you can recognize in the future. And that's the mentality that builds real skill. Because when you understand the mechanism, you stop chasing headlines and start anticipating them. You start seeing these bounces for what they are: mechanical releases, not fundamental reversals. And that perspective keeps you out of trouble. So here's what I want you to answer in the comments. Which group are you in? And if you're in that third group, what pattern are you watching for next? Because the best education comes from active observation, not passive consumption. Now, all of you, regardless of your camp, share one principle. Price always retraces faster than human emotion recovers. That's universal. You can lose 41% in a week and gain 8% in a day, but your nervous system doesn't reset that fast. Your confidence doesn't rebuild that fast. And that emotional lag is exactly why most people make their worst decisions right after extreme volatility. They sell the bottom out of fear, or they chase the bounce out of FOMO. Both mistakes, both expensive. Here's where I stand. I'm not a bull cheering every uptick. I'm not a bear shorting every rally. I'm a student of structure. And what I see right now is a mechanical bounce inside a larger correction. Let me tell you what I'm personally watching. First, I'm watching price interaction around $80. That's the psychological midpoint of this rebound. If silver can hold above $80 through the end of this week with consolidation, not collapse, that would indicate some actual support is forming. If it slices back through $80 like butter, we're probably headed to retest those $71 lows or worse. Second, I'm watching positioning data. Do short covering flows continue, or do new longs actually step in? You can see this in the COT reports, in the options flow, in the futures open interest. If we're just seeing shorts exit and no fresh capital entering, this bounce is temporary. Third, I'm monitoring volatility compression. If daily ranges tighten over the next week, if we go from $10 swings to $5 swings to $2 swings, that's your clue stabilization is finally real. Volatility compression after a spike is how markets digest shocks and prepare for the next directional move. Based on my analysis, this rebound was mechanical, not miraculous. It was driven by positioning unwinds, short covering, and dip buying from opportunistic players. Fundamentals didn't vanish. They just took a coffee break while price caught up to reality. The long-term drivers for silver, industrial demand, monetary concerns, supply constraints, they're still in play. But the short-term price action is governed by leverage, positioning, and sentiment. And right now, sentiment is raw. Trust is broken. People who bought at $110 are underwater and scared. People who sold at $75 are watching with regret. Neither emotion produces stable trends. If history rhymes and silver follows the pattern we saw in 2011 or 1980, the move that follows could involve weeks or even months of choppy consolidation before any sustained trend emerges. That's not a prediction. That's a probability based on pattern recognition. I'm not a financial advisor. This is not financial advice. I don't know your situation, your risk tolerance, your time frame. Do your own research. Verify everything I've said. Check the data yourself. Build your own thesis. But if you made it this far, you're the kind of person who thinks critically before acting. That mentality will serve you well, not just in this silver move, but in every market you touch for the rest of your life. Share this with someone who's freaking out right now. They need context more than they need opinions. Subscribe if you want more breakdowns like this where we focus on mechanics, not hype. And stay ahead of the noise by learning to read the structure, not just the headlines. Think critically, verify data, and keep your own pulse steadier than the markets. Stay sharp out there.